Good morning. Ryan Chen here. Thursday the 23rd of July. Canadian inflation just landed, and it's a mixed bag.
Morning, Ryan. We've got 3 CPI reads out of Canada this morning, all hitting at 0830 ET. Quite the Christmas cracker.
And later in the week, we're hearing from President Trump on Wednesday. Let's dig into what matters for your book.
Shall we start with Canada then?
Here's the board for the day. Right. So 3 versions of annual CPI all released at once. Why do central banks need 3 measures of the same thing?
Fair question. Median, trimmed, and common all strip out volatile items differently. Median removes the highest and lowest. Trimmed removes outliers. Common excludes energy and food.
And the consensus is they stay flat or ease slightly.
Exactly. Median and trimmed both forecast 2.0% YY, unchanged from June. Median at 2.1%, also flat. But the month-on-month? That's the story. Forecast shows 0.2%, a notable dip from 1.0% previously.
So disinflation month-on-month, but annual momentum sticky. How does CAD typically react to a softer monthly print?
Softer inflation weakens the Bank of Canada case for holding rates. You'd likely see USD CAD strength. The dollar pair benefits from the relative rate outlook shifting. If the annuals surprise lower, that pressure intensifies.
And if they surprise hot?
Then the BOC narrative stays hawkish. CAD strength, USD CAD under pressure. EUR CAD and GBP CAD would likely pull back.
Shifting to the UK. Average earnings, Tuesday morning. Consensus, 4.5%. That's a tenth higher than June's 4.4%. Why does wage growth matter so much to sterling traders?
Because the Bank of England watches it like a hawk. Sticky wages can lock in inflation expectations. If earnings keep accelerating, it signals persistent domestic cost pressure, exactly what the BOE fears.
So a beat on wages means the BOE stays cautious on cuts?
Spot on. A surprise higher, say 4.7, 4.8%, would suggest the labour market is still tight. GBP rallies on reduced rate cut odds. A miss, and you're looking at sterling weakness as cut expectations return.
Quick one. How does that typically play with EUR GBP?
If UK wages surprise hot, EUR, GBP drifts lower, sterling appreciation. Weaker wage print, the euro strengthens against sterling.
And Wednesday afternoon, Washington time, President Trump takes the podium. This isn't an economic data release, but markets hang on every word, don't they?
They absolutely do. Trade rhetoric, tariff comments, Fed independence, any hint moves the dollar and risk appetite immediately. The USD tends to strengthen on Trump hawkishness.
So if he leans into tariff talk, we'd expect dollar strength broadly?
Yes, dollar strength, risk assets under pressure, precious metals potentially up. If he sounds dovish on the economy, the opposite, dollar might ease, equities rally.
In other words, watch the headline machine very carefully Wednesday afternoon.
Without question.
So to recap, Canadian inflation this morning sets the tone for North American rates. UK wages on Tuesday. Trump on Wednesday. All 3 move currencies and sentiment.
Keep an eye on the CAD pairs for the largest intraday swings. And don't sleep on sterling if that wage print surprises. Plenty to digest this week.
You can find our free market journal and daily letter at pipinsight.co.uk. And as always, nothing here is advice. Do your own homework. Manage your own risk. We'll be back tomorrow.